Hey everyone, welcome to the KE Report, a daily editorial, chatting with Brien Lundin. Brien is the editor of the Gold Newsletter, also our host down at the New Orleans Investment Conference, this year happening November 2nd to 5th. I'll post a link in the show notes to Brien's newsletter where you can also find out more information on the conference. Brien, as we always do, let's talk commodities, and quite frankly, we have a lot of positive things to talk about price-wise for commodities, especially precious metals. Gold seems like it continues to lead the way. It's over 3,000 and continues to tack on to that number. Silver right now on the futures up to $35 an ounce. It's also options rollover day too, so we are seeing some of these bounces, but it just shows that I guess the market is expecting higher prices in the future. Copper down today, but still around 520. Strong prices across the board for kind of these key commodities for investors. What's been your takeaway from this continued strength in the commodity sector as the broad averages continue to, let's just broadly say, struggle?
Yeah, it's a wonderful thing, isn't it? Everything's going up sharply. I think the latest little boost that the commodity sector has gotten, and in particular copper, has been because of the more tariff rhetoric. In particular, again, calls for up to 25% tariffs on copper. And when that fades away, which it will at some point, I think copper will take a hit, but I don't think it's going to hit the monetary metals, gold and silver, nearly as much, and they'll recover quickly from that because the underlying trend is really so positive. The monetary issues involved are so positive for precious metals. The debt situation in the US and around the world demands lower interest rates, demands a more rapid depreciation of currencies. And there's a lot of money out there that realizes that's buying it. And I do believe the last couple of months, with a lot of the economic war that's been kind of announced by President Trump and his administration, with all these tariffs, I think that's only prompted more buying from central banks trying to get away from or get out from under the reliance on the US dollar. I don't think that they're going to succeed in that in any near term, but the trend is clear that central banks around the world are buying in a very price insensitive manner to gain that protection from the dollar hegemony. So, that's an underlying trend that now we're seeing Western investors try to take advantage of. They get into the sector, they see the move that gold has already made, and they try to leverage it because, or find something that has not moved as much. And of course, that's the mining equities, which are still undervalued even after these big moves in the metals. That's why we've been seeing this rotation into the equities over the past month or two, and especially filtering down to the juniors over the last few weeks, where we've seen financings really flowing, money flowing into the junior sector like we haven't seen for a long time.
Well, Brien, you really nailed it there with that last comment. We haven't seen this for a long time. Think how long we have waited to do an episode like this with you, where we finally have all of the ducks in a row, where we see the metals all moving up in tandem, maybe for different reasons. But it's nice to see a day where you've got copper, silver, and gold all screeching higher. Copper just made a new all-time high this week. Gold's been making new all-time highs constantly, all last year and really most of this year. But the thing that really strikes me, Brien, is when you think about the average price of gold in Q4, I think it was around 2,650, maybe pushing 2,700. The average price for gold in Q1 for these producers of the yellow metal is going to be more like 2,800, 2,900, and we've been over 3,000 for the last, month almost. So yeah. When you think about what the production numbers are going to be from Q1 earnings, is it possible that generalists, when they start screening for outperformers in Q1, can't ignore the sector anymore?
Yeah, I think we've seen that because they don't want to. A lot of them don't want to report at the end of the quarter that they have no exposure. So we're seeing a lot of rotation over the past few weeks into the sector. I think we're going to see even more of it after the quarter end, when the numbers come out and it's obvious that gold, with about a 15 to 17% gain over the quarter, outperformed every other sector except gold mining stocks, which doubled that gain. I mean, The key here that we've seen this year so far is that for most of the year, except for a couple of weeks in late February, the gold mining stocks have dramatically outperformed gold itself. They've essentially doubled the gains in gold. That's what they should be doing. That's what have been waiting for them to do for a little bit over a year now. And now they're doing it. And of course, that's the majors. That's is tracked by the GDX and the big major gold mining index. Now we're seeing over the last couple of weeks that it's going down the food chain, and we're getting those powerful moves in the juniors, and they're getting the money they need to make more news.
Brien, to your point, let's just throw some stats out there about GDX's performance here. GDX has been up 10 out of the last 13 months. It's up 70% in about a year. It's up 40% just in pretty much the first 3 months of this year. So yes, you're right. It's leveraged that move. This has been almost a vertical move for the sector because of the fact, I guess, money is simply rotating into this sector. There's no more denying that people aren't paying attention here because look at some of these moves. What do you do within your portfolio, though? Seeing now that the money's filtering down, but also seeing that the big stocks are also providing that leverage. Do you go further down the food chain? Do you keep a balanced approach? What do you think is the best strategy?
Yeah, I think you do go down the food chain. Of course, that's the sandbox that we play in, so we know it best. You can leverage it other ways by investing on margin, by doing some of the 2x or even 3x TFs, et cetera. But those are, riskier in a different way than obviously the risky juniors. But we know that junior sector and we know what can happen. And frankly, it's a lot more fun playing around in these juniors. In that sector, there are some exploration plays that have the money now to really drill, and that thrill of discovery is wonderful. And what an adrenaline surge it is when one of your big holdings has a big hit. I'm always a sucker for those kinds of plays. But again, the companies that have very large scale resources that have yet to really move for one reason or another, those are the ones that are really going to take off in the near term and offer those kind of drill play results or potential with less risk on the downside. And there's a number of them out there, and they're raising money, and the drills are going to be turning. The drillers are going to have a field day because now it's like it's turned on a dime. This season, everybody's going to be fighting for drills.
Well, Brien, let's dive into some of those stocks kind of in the middle there. Not the producers, not the explorers. Explorers can hit at any point in the cycle, and if they make a true discovery, they're going to get rewarded if it's a big enough discovery. Now there's some tailwinds behind that sector, but those ones in the middle that have ounces defined in the ground and maybe they haven't moved yet, any of those that are catching your fancy, any of those have your eye?
Yeah, it was conveniently, I have my gold newsletter portfolio up on the screen in front of me, and just talking off the top of my head as I go down the list, Banyan Gold has just announced a 30,000 meter drill program. So, they've got 7 million ounces now. And importantly, they're starting to uncover the higher grade that deposit really needs to make it sing. And I think they're going to do that. 30,000 meters is a lot of drilling. And I think they're going to make some big news down the road. I like Delta Resources. They're drilling. They have some high potential holes on a deposit that's somewhere between 1 million and 2 million ounces. They don't have a resource, but they've got a great deposit that has infrastructure you would dream of having. So they've got some high impact holes coming up that I'm looking forward to. I think Kenorland Minerals is a great prospect generator. They've got some drill programs coming up on really high potential targets, one of which may be very similar to the Dixie project of Great Bear. Hawthorne Resources is a new play, a new story out there. We just got it in our portfolio, though it had been in our portfolio a while back. You dropped it because they weren't making any news, and then they came out and acquired a silver project in Nevada that looks like it could have 100 million ounces or more, but it doesn't have a compliant resource. A lot of previous drilling, though, and a fairly simple and relatively low-cost drill program should be able to bring that resource into compliance. And that's a would be a huge catalyst for that company. I like Nucor Gold. They're making a lot of news at their project in Ghana. A longer term project that has a few months, but I love their target is the Prospector Metals. It's a Discovery Group company. They'll be drilling finally this season on one of their great targets that I think is an intrusive in the target that everybody's looking for. And I like the group and I like what they're going after. They'll finally be drilling that. I like Relevant Gold. They're going to be drilling on some targets that could be in Wyoming, that could be essentially an offshoot of the Abitibi Gold Belt, and they control a good bit of that gold belt. High potential drilling that they'll be doing this year. And they just did, like a lot of these companies, it just did a big financing and they're cash rich and the drills will be turning. And as I look down the list, there's more and more of them. It really is a target rich opportunity in the juniors right now.
Oh, it really seems like it. The fact of the matter is a lot of these stocks have already been moving too. Some of them still stuck down near some lows, but a lot of those names you brought up have had some nice gains for their shareholders. Brien, you mentioned the one silver stock, that Hawthorne, that is moving into the silver space. As good as the silver price is done, it's not the same environment that we're seeing in the gold stocks that we're seeing in the silver stocks, or even in the copper stocks for that reason. The copper stocks seem to be lagging even a little bit more than the silver stocks. Is this still an environment where you're focused on gold, or are you moving into these other metal sectors in terms of the equities, thinking that the moves in gold, the moves in the gold stocks are also going to pull those ones up to a greater extent maybe later this year?
Yeah, I think the silver stocks will take off. We've seen it before. I hearken back to the spring of 2016 when the silver stocks across the board went up 3, 4, 5 times over 6 months and really took off. Everybody wanted the silver juniors. I think that's going to happen again. It's just that silver has to get out of its own way. It has to get through $35, I believe, on a spot basis to really break through resistance. And I think the industrial aspect for silver, finally, I've been a big skeptic of that for many years, and I think it's finally coming to the fore and having a big impact from what I'm hearing in the physical metals trading market. So yeah, I like silver. Copper's a tougher nut to crack. People and investors and funds don't often go into junior coppers to play copper. It's more of an individual discovery type of story because it takes so long to get a copper project from discovery into actual production. But still, that's the story for copper, absent the whole tariff thing, is a long-term, fundamental, and incredibly bullish story that I think makes copper and great copper plays kind of a set it and forget it investment area. Just make sure you have the exposure in good companies and don't worry about it for a few years. And I think you'll come back and see that you'll be greatly rewarded for that patience.
Well, Brien, just an interesting question that we haven't had to ask people in a while, and it's how do you avoid selling your winners too early in the environment where the whole sector is starting to swell? And do you have any strategies in your own portfolio about taking gains in stocks that have maybe run 1x, 2x, 3x and rotating them into the ones that haven't? Or do you stick with your winners, let your winners run? How do you handle a swelling tide where you start seeing 100% gains, 200% gains, 300% gains in these stocks and avoid the temptation to pull the trigger too early?
Yeah, I think that, well, number one, I don't have any hard and fast rules. I think this sell automatically after a double or sell half and ride for free doesn't always work. And it really dooms you to relative mediocrity in terms of performance. I think you have to look at each story individually. And what happens in this sector is that you'll come across an opportunity that you really like. And if you're, like me, fully invested, you won't have the available free capital to take advantage of that opportunity. So then you take that new opportunity you've discovered and put it up against your portfolio and go down a list of your companies and say, which of these companies is this new opportunity better than? Which of these companies will this new opportunity almost assuredly outperform? then that gets you your sell list. You don't have to sell everything. You can sell a little to create that capital to take advantage of the new opportunity. If you're always worried about selling too early, then you're almost certainly doomed to sell too late. So you really need to take the money off the table periodically. You need to dip a ladle into these capital gains that will suddenly appear in your portfolio to a great extent. And one of the things I learned in the 2000s bull run is that you need to not only sell some of your winners and take some of those gains off the table and into cash, but you need to take that cash out of your brokerage account. You need to get a couple of layers of friction before you actually can put cash back into your account, take that money and put it in something illiquid, because otherwise you will end up holding the bag when the music stops. And, these kinds of cycles, they'll stop at some point for a long time, but they'll also have intermediate stops along the way that will shake people out. And even during those corrections, you will kick yourself for not having sold some of these companies before that correction. So when things can't get any better, that's when you really need to look at your portfolio and seriously consider taking some profits off the table.
Yeah, that's a very good point too, Brian. I think we've all ridden that wave higher at points and then watched it come back down as well. I never have a problem with people saying that they are locking in some profits at points because sector is still risky. But as we've seen over the last years, that these stocks can just keep on running. And right now there are stocks that have been running for even more than a year and completely outperforming. So hey, there's always that argument. Make sure that you can at least move some money around, take advantage of those gains, but also sometimes make sure that you do take some money off the table. And even as you said, move it out of your brokerage account. I really like that. That made me chuckle. Brian, we'll wrap it up here. Again, Brien Lundin, editor of the Gold Newsletter, also our host down at the New Orleans Investment Conference, November 2nd to 5th. Brian, great chatting with you. We'll chat again in another couple weeks.
Great. Thanks, guys.